What's up? So with the Russia-Ukraine crisis ongoing, many investors are wondering how wartime affects the stock market. In this video, we will look at how the stock market has historically done during times of war crisis. We'll cover the types of stocks that typically do best during war times, and the type of stocks that typically do worst. At the end, I'll give my own opinion. If at any point you decide to like this video and find it helpful, don't forget to hit the like button, because that's what it's there for. Also, feel free to lurk below and check out the links in the description. You can get free stocks, free crypto, also a $30 to sign up with Rakuten, a site where you can earn cash back on everyday purchases. Without further ado, let's get started. The stock market is always looking forward, trying to price in the future. The one thing that the market hates is uncertainty. Oftentimes, the market reacts worse to the rumor of a negative event than it does to the actual negative event. In other words, investors are trying to get ahead of the curve, and thus, the event can already be priced in. Kind of reminds me of the Joker quote from The Dark Knight. Nobody panics when things go according to plan, even if the plan is horrifying. Why? Because the plan is already priced into the market. At that point, the only thing that matters is whether or not the event is worse than expected or not as bad as expected. If the market is pricing in something terrible and it only turns out to be mildly bad, the market can actually rally on that news. This is why it is so dangerous to try to time the market and sell or buy on the news when everyone else has already bought or sold on the rumor. You can potentially find yourself one step behind. But if bad news comes completely out of left field, that is when we can see sudden and steep declines in stock prices. But getting back on topic, needless to say, the market does not like the uncertainty that comes with impending war. But historically, it tends to shrug off the war itself. War is incredibly terrible, so it sounds very callous to say this, but history would suggest that war is actually a buying opportunity. In general, if there is a pre-war phase, an increase in the war likelihood tends to decrease stock prices, but the ultimate outbreak of war increases them. However, when a war starts suddenly as a surprise, the outbreak of war decreases stock prices. This phenomenon is called the war puzzle, so it really depends on if the market has a chance to price things in or if it doesn't. So let's look at a list of geopolitical events and the corresponding stock market reaction, as defined by price activity in the S&P 500. Granted, many of these historical events may have experienced more volatility if they occurred in the modern era of high-frequency algorithmic trading. Starting at the bottom of the list first, the market averages a minus 5% drawdown with an average 22 days to bottom and 47 days to recovery. 5% really is not a terrible drawdown, and a 47-day recovery period is nothing for any long-term buy and hold investor. Some of the worst drawdowns on the list include an 11% drawdown during 9/11, a 17% drawdown during Iraq's invasion of Kuwait, a 13% drawdown when North Korea invaded South Korea, and a 20% drop during the Pearl Harbor attacks. But the market was 15% higher 1 year after the Pearl Harbor attacks. The largest historical drawdown due to war occurred when Nazi Germany invaded Czechoslovakia in 1939 and when Nazi Germany attacked France in 1940. The S&P 500 fell by 20% and 26% respectively during the following 22 trading days. However, 1 year after these instances, the market was up almost 19% and 9.2% respectively. Additionally, from the start of World War II in 1939 until it ended in late 1945, the Dow was up a total of 50%. That's more than 7% per year. During both world wars combined, the market grew 115%. Strangely enough, the market actually tends to be less volatile during times of war compared to the historical averages. We tend to think of the US market as, quote, the market, but indices that track the markets of other countries can be much more volatile during times of war outbreak. For instance, the MOEX Russia index plunged 33% in 1 day when Russia invaded Ukraine, and it had been getting crushed even before that. So what kind of stocks perform worse during a war outbreak? Travel and leisure stocks tend to do the worst. This is pretty obvious. If you had travel plans to an area that is either a war zone, could become a war zone, or is even close to an area that could become a war zone, you're probably going to cancel your plans. Why take the risk? Additionally, planes have to reroute around these areas, causing further complications, cancellations, and delays. So what kind of stocks tend to do best during war outbreak? Again, pretty obvious, defense stocks. Northrop Grumman, Lockheed Martin, Raytheon, etc. This is the equivalent of buying Clorox stock when the COVID pandemic started. It seems like shooting fish in a barrel, but the timing is challenging. These kind of stocks can pump and dump when it seems too easy. Sometimes by the time you buy in, it's too late and the stock comes crashing down. Gold also tends to spike during times of crisis. It's typically seen as a safe haven when there is turmoil in the world. But again, if you try to trade into gold, you risk entering a position when the market is at peak fear, and then the gold prices go back down as people start to feel less fearful. But with Bitcoin being digital gold, you would think that it would trade similarly, but Wall Street treats Bitcoin strictly as a risk asset. During times of crisis, the riskiest assets tend to sell off the most, and Bitcoin falls victim to that. However, I will say the underlying value of a decentralized programmatic monetary system such as Bitcoin becomes much more apparent during times of crisis. So these times could potentially be long-term bullish for Bitcoin as more people learn about it and learn about its value. But that's a video for another day. So what's the bottom line here? Is it time to buy the dip? Well, yes and no. Historically, these geopolitical conflicts tend to be buying opportunities, but a geopolitical conflict is only one variable in the complex equation of what causes the stock market to go up or down at any given time. In other words, it's only one piece of the puzzle, one tile of the mosaic. Other factors include, but are not limited to, publication of economic indicators, concerns over inflation or deflation, governmental fiscal and monetary policy, technological changes, natural disasters, corporate performance data, regulation or deregulation. The list goes on and on. For example, right now the Russia-Ukraine situation is spooking the markets, but I would say concerns over the Federal Reserve raising interest rates to combat inflation is spooking the markets even more. The market has to try and price in the new macro environment, and it makes things very turbulent. So what are my thoughts? Am I buying the dip, or am I panic selling my entire portfolio and stuffing it under my mattress? For me, it's business as usual. I'm just dollar cost averaging into the same ETFs that I always do and holding on for the long term. It isn't sexy, but it's pretty effective. Time in the market beats time in the market, etc., etc. But with that said, when the market does go down, I will try to scrape up some extra money to throw at it. At the end of the day, every bear market in the US stock market has eventually been erased by a subsequent bull market rally. Sometimes it takes weeks or months, sometimes it takes years, but the point is, if your investing time frame is measured in years, no correction or crash is really a concern. By this logic, every single crash or correction is a buying opportunity for long-term investors. But if you found this helpful, consider hitting the like button and subscribe for more content like this. Again, also consider checking out the links down below. Currently down there you can get 2 free stocks of Webull, potentially valued up to $2,300, $30 with M1 Finance, $50 of Bitcoin with Celsius where you can earn interest on your crypto holdings, and $30 with Rakuten where you can get cash back on online purchases. However, these promos do change over time. As always, this is not financial or tax advice, just entertainment purposes only. So thanks, and I'll see you in the next video.